Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show, and I have got our favourite guest, Mr. Jamie Van Burgal, back in the new podcast studio. Jamie, what do you think of this?
It's delightful. It makes me want to read a book.
Welcome back, mate. It's a pleasure to have you back.
Too kind. Thank you very much, Neil.
Been happening since last time we caught up.
It has been a little longer than a quarter, but not too much longer. Quite a bit has happened. The government have made one or two announcements, as I'm sure you're aware of, but the property market, especially here in Perth, is still going up and up and up.
It is, bizarrely. And we've seen Sydney and Melbourne downtrending as well, which is interesting. I'm sure we're going to cover all of this in today's episode. There's a lot to unpack, and I think it'll be a pretty important podcast that people can refer back to over the next couple of weeks because, like you say, there's a lot changed, right, in the government's new budget announcement. Negative gearing scrapped, apart from on new builds. Capital gains tax changed. Discretionary trusts, distributions now taxed at 30%. I mean, all this it's all proposed, right? It still needs to be legislated, but
I do feel there's something in the air, Neil. There's something in the air that there's a winds of change about, and I'm not as pessimistic as others in the media. I'm still quite optimistic because property is very stable, and I love property. So why not be bullish about the future?
And we've still got lots of people wanting to move to this beautiful country.
Correct.
Not enough houses being built. So the supply and demand fundamentals are still well and truly outweighed inside of too much demand, not enough supply, which is why, and with all respect, valuers are generally pessimistic and risk averse, right?
Correct.
So for you to sit there and say that you're still optimistic that's a very strong position to be in.
We'll preface that throughout the course of this podcast because it depends on how optimistic you anticipate me to be, because I don't think we will see the same level of growth as we have over the past 2 years. I think we are sitting at a point now that change is afoot.
We'll dig into that as well, but I'm guessing with the changes from the government, the markets are driven by two very important emotions, which are fear and greed, right? And when people are fearful, they sit on the fence and do nothing. And when people are getting greedy, they FOMO in, and that's where we've seen more than double-digit returns over the last 3 years, right?
Exactly.
So let's start macro. Let's look at the Australia in general, then we'll kind of niche down into Perth and start digging into some more kind of micro data. So what's happening across the country, Jamie?
So the nationwide, it's a little bit of tale of two sides of the country. Adelaide and Perth are still going reasonably strong. When I look at my numbers, Perth is the standout in terms of, for the past quarter, its growth levels nearing 5% for quarter on quarter, which is very healthy for the past quarter. Adelaide around 3%. Actually, Brisbane itself as well. Brisbane has reasons why it's still seen a good growth, but Melbourne, Sydney, Canberra, they're all experienced a downturn over the past quarter. They were quite stable this quarter before, probably at that precipice. Sydney, for example, are still up 2.2% over the full year up until end of March. But down this quarter quite significantly, almost 3%.
Big drop. Big drop.
Very big drop. Yeah. And I think affordability, we've talked a lot about that in these podcasts, but affordability is always going to hit the top end of town, let's say, more so than the emerging markets like Perth and Adelaide. Mm-hmm. So I'm not surprised. The interesting point is we are bridging the gap now, Perth and Sydney. The gap was around 900,000 in median house price at the end of last year. This quarter, because they're dropping, we're increasing, it's in the 500s. Now, that to me is also an important part of the story, because does that mean that Perth is reaching our ceiling? Does that mean that Sydney have, let's say, reached their floor? Sydney, for the listeners' benefit, is now at around 1.5, 1.6 median house price. And we, according to REWA, a 920,000 median house price, but according to Domain, which is the national measure, is just over 1 million. So,
okay.
Yep.
Interesting. And how far can it go is the question on everybody's lips, right? For probably the last 12 to 18 months, a lot of commentators have been saying that, Perth has run out of gas. It just keeps going, doesn't it?
It does keep going. We are seeing through the valuers on the ground, though, that it has eased. Mm-hmm. I use that word carefully. It has definitely eased over the past weeks, month or two. So it's very early days to make that call, and whether that's we're going to be in store for a sustained period of stability or easing. Like I said in the beginning of the podcast, some commentators believe that we're going to fall off the edge of the cliff. I don't believe that. I'm a lot more bullish than that. There are some commentators that say we're still going to see double-digit growth going forward. I also don't believe that. I think we are at a point now, also talking to, we've got 25 valuers on the ground, so we've got a fair snapshot of what the market is actually doing in WA. They are reporting longer listing periods for houses. They're actually reporting the odd property that is coming in under asking price. And as you know, there has been a common trait for real estate agents to put the from X or Y in their asking price, and that's coming off a little bit. They are staying on the market a little longer. So I'm cautious, but I really, truly believe that the underpinnings, the supply and the demand side, we've still got people coming into our state. We are looking good for a period of stability at least for the next year or so.
It's interesting because we sent one of our team members to REWA to do some CBD points for their ongoing licence requirements, and they said they sat in a room with 50% buyers agents and 50% real estate agents, and they said something very similar. There's a lot more patience in the market now, where people were FOMOing in before and literally scrambling over the top of each other to try and buy something. But now with the price points where they're at, and the change in not so much sentiment, but the change from what the government have brought to the market, it's probably changing sentiment in the market. But like you said there, supply and demand, we still need places to live. It's probably just stopped people from being as aggressive as what they were. And now we might be, would you say we're normalising, or we're still, is it just gone from white hot to red hot? Or are we talking?
I think we are normalising.
Yeah.
We're in for a period of we won't see double-digit growth for quite some time, even though the supply hasn't caught up to demand. I do believe that the sentiment is really important, because we have one newspaper, the West Australian, and all it takes is one or two commentators on the front page of that newspaper to say, I think we're going to hit a recession. It's a shocking headline, but you only need a few people to read that and then to back that up in the property pages to say, listing periods have increased. It doesn't take much to have sentiment decreased. That's an interesting point. We do a survey, what's called a market insight survey, and this is nationwide. We've got 190 valuers in Australia, CBRE, and that is really interesting to delve down into the stats. I'll just talk you away for a minute. The previous quarter when we did this survey, we ask, do you think that the property market in the next year will go up between 5 and 10%, over 10%, reduce or stay stable? And if I get this right, it was over 80% of our valuers at the last survey, so that survey would have been late last year when they were asked these questions, over 80% believed that it would be over 5% growth over the past year, and quite a number of that 80% over 10% as well. This newest survey, and this survey probably only came out 2 or 3 weeks ago after the announcements by the government, the sentiment changed dramatically. There is only 30% of our valuers believe that we will see in excess of 5% growth over the past year. That's a massive shift. Yeah. And I talk to the valuers on a daily basis. Some are still really bullish if they're in the outskirts, if they're in a construction suburb with lots of land. They're seeing lots of activity, lots of transactions. I talk to my Western Suburbs valuers though, and they are a little more panic stations. They are talking to agents and thinking the worst, whereas the people up in Alkimos, Byford, they're not thinking the worst. They see the level of interest at these new developments, and they're going, we see a sustained period of interest.
Very interesting. Very, very interesting. Let's dig into that a little bit deeper, right? Because they generally say smart money moves first. So Western Suburbs, if people are stopping by in there, is that something we should be alarmed about?
It's always more temperamental because we're talking bigger dollars. Your Cottesloes, your Peppermint Groves, Dalkeiths. Over the past 2 years, they have seen significant growth, and with the interest rate rises, and while that doesn't affect everyone in the Western Suburbs, it does have an impact. And I would suggest, and maybe you'll ask me this question a little later, but the government changes, yes, they affect sentiment because it provides a little bit of an unknown to those that are not knowledgeable enough to find out whether it affects themselves. That drives a little bit of the sentiment. However, it's the interest rate rises that everyone can understand. And we've had the interest rate rises this year, I believe, have had an effect. And if the commentators and the people are correct in saying that we may get at least 2 more for the remainder of the year, that's what worries me, because that hurts everyone.
You've got to take the wind out of the sails, isn't it?
Yeah.
Yeah. So we've got the Western Suburbs slowing down. We've still got the fringe suburbs moving now. Let's touch on the proposed budget changes, right? Because they're essentially targeting investors, right? If you're a homeowner, you should not be affected by this one bit, but the sooner you start thinking about investing your hard-earned money into real estate, they're essentially scrapping negative gearing on established properties and changing capital gains tax from 50%, so you would get 50% that you're not taxed on and pay tax on the other 50%. Now that's changing to 30% and an indexation as well, unless it's a new build. So if it's a new build, then we're talking the Alkimosses, the Byfords, these kind of fringe suburbs where new product is still going, and potentially where the property spruikers are now directing their clients away from established product because they now lose negative gearing, but negative gearing is still there for new build product, and capital gains tax is still 50% on new build product as well.
And I think if you compare that apple and orange, being a new product versus an established product, why wouldn't an investor then move
Makes sense.
to one versus the other? What I am a touch worried about is now the greater proportion of investors will be now competing with your first home buyers. First home buyers have been able to, over the last few months at least, been able to get into the market somewhat. I've got the stats in terms of how much lending first home owners have been lending in the past 3 months, and it's increased. So they've been able to get into the market, onto the property ladder.
Yeah, it's a good sign.
It is a really good sign.
Yep.
But what worries me is if the investors en masse start competing with that product, we'll see similar to what we saw in the boom, whereas no one could get a look in at a home open because the East Coast investors had already bought it that morning.
Yes, and we could have people camping out at development sites again and trying to put the name on blocks. So if anything, we're probably going to see that transition from the infill suburbs, which is where we need more housing anyway to stop the urban sprawl. Now we're essentially, the government, bless them, try to fix one problem but create 10 others, right?
Exactly.
So now they're just going to be targeting land developments. People are going to be building your stock standard 4x2s. We're going to get further and further away from the infrastructure. More schools, more roads, more hospitals needed further and further away, which needs more taxes. It's a vicious cycle, isn't it?
The urban sprawl is alive and well in WA, but I think that's also where the land is as well. We still like, Perth is different to the East Coast. We're slow going to this living in an apartment. We haven't quite caught up to the rest of the world in that regard. We're slowly getting there. It's changing slightly, but there's something about living in Perth that you want your al fresco, no matter how small that is. You want your backyard, no matter how small it is. I know the block sizes have decreased, but we have a natural aversion to strata titled properties, and I don't see that changing quickly. And it could have something to do with the fact that we live in the best place in the world. Beautiful weather. Why wouldn't we want to spend time in our own backyard rather than in a high-rise apartment?
It's not like we're short on land, is it? We're one of the
Exactly.
biggest countries on the planet.
Exactly.
And we're all shoehorned into the same place.
Yeah.
Before we get into houses versus units, because I know there's been a little bit of a transition there as well, where we are seeing opportunity in development now as well, specifically with the HMO product, is you're wanting to do subdivision, so buy an established property in an infill location on a subdividable block, subdivide the block. Your front house is going to be negatively geared. Build a 6-bedder on the back. Positive cash flow from that one offsets the negative gearing on that, because you can still use negative gearing from property to property. And then you've got 2 properties which are potentially neutrally geared in an area where nobody else is buying investment property. So that's where we're seeing the opportunity right now for ourselves and our clients.
And I think that's where we're going to be looking more broadly to different products. Right now, we're staring down the barrel of a period of, 3 to 5 to 6%, max growth over a sustained period of time. The product that you're talking about offers far greater percentage and far greater yields, and that is where investors should quite rightly be looking.
Yeah. Well, the phone started ringing a lot more after the government. I think everyone started Googling cash flow positive properties, and we started popping up. But I've just been over to Melbourne as well, and interesting when you spoke about the alfresco and blocks getting smaller. Driving through Port Melbourne and South Melbourne, and there's these beautiful little old miners' cottages, like terraced in a way, so there's like 10, 15 of them in a row. They're probably 130 square metres, if that. 3-bedroom, 1-bathroom, beautiful little homes. We need more of them.
A different product.
Yeah.
And yet they don't seem to take off. The first new product, and I think we lost our minds a little bit, where I remember this quite well, we're in Ellenbrook at the time. They were putting a new product in where it was under 200 square metre blocks, and our average back then was 450, I think, our average size. And I remember valuers in the team, they were going, no one's going to buy these things under 200 square metres. But that's actually becoming more of the norm now. Yeah. I say that, but if you've got the money, you will naturally want something which is bigger. Yeah. You would naturally, and that is where your growth is. Your growth isn't in the bricks and the mortar. The growth is in the land underneath. Yeah. And that's property 101, valuation 101. Your appreciation in your growth will be in the value of the land. So of course you'd want as big a parcel of this, of our property market as we can.
But in a world where real estate's becoming more and more unaffordable, what you need and what you want are 2 different things, right? So do we just need a smaller house on a smaller block to get your foot in the market, to start building some equity? It might not be in the location you want to live in or that you grew up in, but it's affordable and you can find yourself there and get yourself some shelter and stay there for 5 to 10 years. Look, I think people, especially the younger generation that are coming through now, they want the Mac Mansion, but they don't realise that to get there, that it takes time to build the wealth to get to that point, right? So
we talk about that at barbecues all the time. And again, it sounds like one of these back in my days, it was so much better, but it's not meant to be the case. It's just we were satisfied with the very bottom of the market just to get our foot on the property ladder. And my first home was a 3x1, and it wasn't in a very nice suburb. It was surrounded by not very nice properties, and yet that got my start. And we didn't stay there long. And I look at my own children now that are looking to purchase. The problem number one is that initial outlay, even for the substandard, let's say, the entry level product, is very unaffordable for young people now. So I think they're going to be forced into not looking at the Mac Mansions. They're going to be forced back into starting humble, starting small.
I think it's a good thing though, right? It's definitely a good thing, but not a good thing if you're trying to get into the market and challenges. So I'm going to give you a bit of a double barrel question here, right? So I want to know if there's been a shift between owner-occupiers and investors in Perth, and also is there a shift from housing to units? We touched briefly on the unit thing there, and we haven't got a lot of apartment developments out the ground recently because of the bottom line, and the feasibility hasn't been stacking up unless you're in the western suburbs, unless you're Paul Blackburn or Mirvac. But are we seeing more of a shift towards units from housing, and are we seeing more of a shift from investors to owner-occupiers, or vice versa?
That's a very big question. So apologies if I miss the second half while I start answering the first half. The first one is in regards to investor borrowing versus owner-occupied. And I briefly touched on this. What's pleasing is the fact that the first home buyer loans, and I'm looking at my notes here, were up 15% quarter on quarter. And when you think about the year-on-year increase, it was only 2.9%. So this past quarter is the first time that they've been able to actively get onto that ladder. Investor borrowing is trailing owner-occupied, and to give the listeners an understanding of what type of money we're talking about here, 16.4 billion was investor borrowing for the year up until at the end of March, but owner-occupied borrowing, 26.6 billion. So there's still quite a gap there. But what actually surprised me was how much investor borrowing there is. And it got me thinking, because we have seen the East Coast investors trail off. They're not as active, and I did float this at the last podcast as well, but they are not as active in the market. It's a proven fact at the moment. So who are these investors? And I do wonder whether they are mum and dad Santa Claus. And what I mean by that is, with the struggle that young people have to get into the market, are the investors actually your mums and dads purchasing a property for the benefit of their children? And I know friends that have done that. They believe that that's the only way for their children to be able to get a little kickstart to their property career, let's say. So that's investor owner occupier. Investors are looking at yields, and it's a profit. We're sitting at the moment around sort of 4% for houses, 3% for units. Units have always trailed houses, similar to what we were just talking about. We are the highest in the nation for yields. However, only just now. The gap is dropping. Sydney
is that for housing or for units?
For houses.
Right, okay.
So Sydney and Melbourne, surprisingly, their yields are not too far off ours. Sydney, yes, it's unaffordable, I think, for an investor to walk into that market, but their yields are 3.8, 3.7% for Sydney and Melbourne, respectively. But Melbourne now, with its median house price, I can see why people are at least looking there. Their yields are solid, and they're probably potentially looking for capital growth, whereas they look to WA and they think, well, will we get capital growth when we've had such a sustained period over the past 2 years of the spike that we've encountered? So that's where I say I'm bullish, but I'm cautious in the same respect. I'm bullish the fact that we're not going to hit a recession, that dreaded R word. But I'm cautious in the fact that for anyone to think that we're going to experience significant growth like we have, that's, in my opinion, not going to happen.
Okay.
Yeah. And in houses and unit differential, I can't remember whether we've spoken about this before, Neil, but between 2005, 2022, so quite a period of time, the difference, the capital difference between houses and units, their median house price was around 100,000, and that moved up and down with the respective changes in the median house price and unit price. That doubled straight away from 2022 to I think 2023. In the space of a year, that gap widened. It's now at around $250,000, $260,000. That's in actual difference in dollars and cents. I thought about that, why that is the case, and as a percentage, I'm not surprised that has increased, because you do the maths, one increases that dramatically. There is going to be
an opportunity.
That's right. But that stayed stable now, so that may be the new norm. That difference may be the new norm. It stayed stable for the last 2 years. I believe that we're seeing and I think there was one other part of your question which I've totally slipped my mind now, Neil. But
I think you covered them.
Okay.
So is the owner-occupier versus investors, and
Yes.
the houses versus units.
Yes.
What I found interesting when you spoke about the investor loans versus owner-occupier loans, there was $10 billion difference between them, right? I expected that to be a lot bigger. Like, I expected it to be,
I did as
60-70% different between them, but to just see that differential there was quite alarming in a way that there's so many investors coming through, which then when you look at the proposal from the government, you can kind of understand why they're trying to put the brakes on that. APRA stepped in previously, and then stepped back out and it didn't really do much. So maybe the proposed changes are the handbrake that they're trying to apply.
Yeah, it's really difficult to get a feel on whether it will impact the local property market in WA dramatically. I think the changes are not as drastic. It's never as good and it's never as bad. It's somewhere in the middle. And I believe that those changes, and this is backed up by actually a question on this survey to our CBRE valuers at least, was what do you think is going to be the biggest determining factor over the next 12 months? Would it be the changes to CGT and negative gearing? And that came in second. The first was interest rates, which I'm not surprised. That is your number by a significant margin. So interest rates, our valuers believe that's your primary determining factor, followed by the changes, followed by affordability. So there's your top three, let's say.
The top two, interest rates are trending up again, potentially, like you say, potentially 2 more by the end of the year. And the proposal for negative gearing, we're going to find out sooner or later whether that's going to get legislated. Do you think they could pull back on that? Do you think they could change their mind? Or?
Well, as going into this podcast today, it hasn't passed Senate. So this whole point could be a moot point.
Yeah.
But look, I think it will go through. I don't think it's very popular.
No.
They haven't been able to sell it very well. And I'm certainly not in the business of saying that it is, either good nor bad. It is what it is, and we deal with it. But we certainly haven't seen a massive drop-off in interest, but it has been a softening that's been building, I would say, over the past 2 months because of the interest rate rises. This may exacerbate it slightly.
It's kind of like when petrol prices go up. You kind of get shocked at first, don't you? Think, I'm not going to pay that. And then all of a sudden, $2.20, $2.50, it kind of becomes the norm.
It does.
So I think, at first this will be a shock to investors, but it's just an additional cost to play the game now, I see. If you think about a property that's $20,000 a year negative geared, they're only claiming back, $6,000 to $7,000 anyway. So there's still a buffer there that they've lost, and they're hoping that property gains in value more than what they've lost to put them in a positive position. So again, if they pay more tax on the back end, if they're losing more money through negative gearing, people still need places to live. People still have capital that they'll want to invest. And I think people will just adapt to the new rules and, they'll sit on the fence for the short period of time, but then they'll realise that the market's going to keep moving wherever that is in the country, because as we know, we've got different market cycles moving at any time, and they'll be looking to put the money somewhere, right?
And I think over the past few months, what's been made clear to the general public is world politics can potentially have a very devastating impact on your back pocket, on the economy in general. And what is a stability in all of that? Exactly what you just mentioned. The stability is your bricks and mortar on a piece of land that has a physical certificate of title that's in your name. You can't change that. You can't wipe thousands of the worst. You will always have that property and you will always be able to see it. That's why it's been so popular as an investment. And we're not immune in WA to the boom and the bust. I'm just glad that I don't see a bust on the horizon.
And we can always still add value to properties through renovation, subdivisions, development, stuff like that. What we're seeing in the market in terms of growth and areas slowing down. So we touched briefly on the western suburbs there, and we mentioned about the fringe suburbs where there's new builds going on. What are we seeing in terms of when the kind of spike in Perth happened? We've seen the kind of lower price point areas spike, and then they started pushing up against what we said the mid-tier, which is where all the owner occupiers were trying to upgrade themselves. So what are we seeing there in terms of capital growth and in the different kind of segments, if we want to call them that?
Yeah, I did a bit of a deep dive in the past couple of days in regards to particular suburbs where we're seeing the most growth. And it's always interesting looking at the stats. There's a lot of suburbs in Perth, number one, and there are certain suburbs with a low transaction volume. So you will get outliers. But if I take out those outliers, it's quite interesting. The biggest growth over the past 12 months has been well-located suburbs. And I'm talking East Perth, I'm talking West Perth, I'm talking Cockburn, and I'm talking Mandurah. There's your top four. Now, the listeners may not know where Mandurah is, but it's a brand new estate south of the river in close proximity to the freeway. It's a big land estate, it's brand new, and it's not actually that far away from the Perth CBD. Very easy train line.
Yeah.
Correct. Cockburn, it's becoming quite a hub there down south, and East Perth, West Perth, proximity to the city, and also potentially some of that movement towards units as well.
Yep.
They're looking in those suburbs more so, and this is just for houses though. The growth, not combined, but yeah, they're our highest suburbs by median price growth.
What sort of movement have we seen in them?
So we're talking big percentages over the past year, and these just roll off the tongue. But, Mandurah up 140% over the past year, according to our stats. East Perth, 73%. West Perth, 64%. Cockburn, 62%.
Yeah.
These are massive.
East Perth and the West Perth are surprising, considering they're landlocked. When you look at Mandurah up, then it's not as easy to say as what you make it sound, right? It's actually difficult to get it out. A lot of land getting built, land getting released, so purchase prices at $400,000 or $500,000. All it takes is a few people to sell the finished product in there, and all of a sudden you've got huge capital growth, right? But East Perth and West Perth, not as easy to get that kind of price point up. So I wonder what is driving them price points. Do we have any feedback or information on that?
Look, I think the people are looking for value, and they can look to the western suburbs, but it's unaffordable for most. But East Perth and West Perth, they're closer to the CBD than the western suburbs, and this is. I go back to the famous movie The Castle. I'm sure you've watched it, Neil. I think it's the Kerrigan. He says location, 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 and this was years ago when this movie was made. That hasn't changed since then. And albeit they were living right next to an airport, but this East Perth and West Perth, location, 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 right next to the CBD. And if they're getting a little bit of land attached to it, because there is still, villas, townhouses, something with a little bit of land in these areas, they're not just only units like Perth Inner, people are seeing value. These were, over a year ago, median house prices probably around that low 1 mils. So when you think about what 1 million is nowadays, I'm not surprised that we've seen such significant growth in those areas. Interestingly, on the flip side, there are a number of suburbs that are not seeing half as much growth as the suburbs I've just mentioned. And it'd be remiss of me not to reference what was spoken about, I think about a year ago on this very same podcast, where we were talking about the Armadales, the Medinas, the Midlands, and we were talking about how much significant growth. They were leading the nation in some of those suburbs. Armadale was leading the nation in terms of the amount of median house price growth. And I cautioned the listeners at that point, and I'm not always right. I'm actually, so when I am, I like to highlight that when I am. But I said, back then, we've got to be cautious when we see such high growth. Is there still room for more growth? And what we've seen over the past year is very, very subdued growth. So when we talk 60, 70% in the well-located suburbs, in your Brookdales, Armadales, Medinas, Kwinana, we're seeing in between sort of 8 and 15% growth over the past year. I say healthy. They're still healthy.
It's still healthy. But
you're still
60,
making
70.
money. You'd much prefer 10% on your property than negatives. So this is not a negative against these suburbs, but this is an example of the entry level.
Yep.
And I believe it's an example of hitting an affordability ceiling.
Yeah.
And I back that up by our current median rent that we're seeing as well. For the past almost a year, we've seen no growth in the median rent. And I think that's a good thing. We're basically seeing a ceiling, and yes, we may see slight growth there, but we're seeing a ceiling. People can't afford more than $800 a week in rent to live in Armadale, which is still 45 minutes away from the CBD.
Yeah. And when you think of the stats that you spoke about earlier, I think you said 15% of first home buyers, was that right?
Yes, 15.
So if you think about these low price point areas where the first home buyers are trying to get access to now, they're obviously limited to what they can pay. So as we said earlier, there's a bit more patience in the market. People aren't FOMOing in anymore and paying stupid amounts. So now the investors have kind of left their markets because they've got to a certain point where the yields aren't attractive anymore. It's now left the first home owners or the first home buyers to get in there and buy at a price which is now classed or deemed as affordable for them, I'm guessing. So
that's right.
Yeah. Very interesting. Very, very interesting. You mentioned something about airports there on the castle. What's happening with Perth Airport? We're getting some big infrastructure upgrades there, aren't we?
And that's another thing. If you are close to a hub where infrastructure is proposed or is in action at present, that can only be a good thing for property owners. I'm not sure you'd want to live right on the tarmac of Perth Airport, but there's definitely growth happening there. But we are seeing a lot of money being spent here in WA, and that is good. That stabilises our economy. The mining, I'm no expert in mining, but that the iron ore price, for example, I've referenced that before. That's sitting around $100 I think the last time I looked. It's quite stable. That hasn't fallen off a cliff. There's still activity. AUKUS is still on the horizon, which means the defence is still looking for houses to buy. We have a lot of activity. You talk about airports, Bustleton Airport, we're getting a lot of infrastructure here in WA, and that's a good thing.
It is. It is, because families generally follow infrastructure, right? If there's shopping centres and transport links and stuff like that, this is where families want to live. Mm-hmm. And whilst investors are good for the market, homeowners are generally the ones that push prices up because they get emotionally attached to things as well, don't they? Yeah. Any other kind of infrastructure that we need to talk about? We've spoke about AUKUS before, right?
We have, indeed.
We know it's happening. We know there's... What was interesting, though, you said that Kwinana was one of the slowest markets to move now, considering, there's still a lot of people looking in that location.
I do believe, though, the defence is looking for new product. So I think I referenced that there are some new estates being built down in Mandurah, which is even further inland. That's where the land is. If you draw a straight line between the Kwinana going towards the hills, you'll get a fair chunk of open field. At some stage within the next 5 to 10 years, that'll all be high density, I'm assuming. Don't buy up there and without actually checking the zoning. Yes, that's right. No, but Mandurah, for example, is going to be massive, and that's been a horsey rural location for years and years, and that's just going to be split up into small blocks.
The Navy are going to build lots of defence housing there.
Correct.
Yeah, interesting. Let's finish it off, Jamie. Let's wrap it all up. So where do we think we're going to be in the next 6 months and 12 months in the Perth market?
Well, we're in the middle of winter. Are we in the middle of winter, Neil? It's a bit
felt
rainy.
like winter last week, but today is beautiful out there, isn't it?
It's a bit, we don't really get winter in WA. Yeah. But winter, in my opinion, is not the strongest season for selling property. Our valuers are already reporting, and I don't know whether I referenced this before, but the listing time on the market has doubled in the past month or 2 months.
What's that gone from like 12 days to 20?
It's still low.
It's
still low. But the amount of listings on the market has hit higher than 5,000. So this is evidence that shapes what I'm about to say next. But we haven't had over 5,000 properties on the market since November 2024. The balanced market is still 12 to 13,000, so bear that in mind. So we're still low, but it's increasing, and it's increasing by the week. And leading into winter, slightly less activity happening, especially from the investor market, the mums and dads, the owner-occupiers. And so I believe that we're in for a period, for the next 3 months, we may not see much growth at all. If we saw 4% growth this past quarter, I would be surprised if we hit that this quarter. But I do not believe that there's any negative growth on the horizon for the foreseeable future because of supply and demand issues. I would not stop a transaction or making a decision in regards to property. If you see something, now is always the best time, especially if it's a deal. Yeah. But the beauty of buying a property right now is you can negotiate. And this is the first time in about 2 years that it's slowly turning away from a seller's market to a more neutral market. Certainly not a buyer's market at this stage, but we're at a neutral market. Certain properties are transacting less than asking price, and people have options. Options is where it needs to be at. So my crystal ball is that we see very marginal growth, almost neutral growth over the next quarter to 2 quarters. However, in and of itself, I count that as a win.
Especially with the way it's gone, right? Nothing goes up forever.
Correct.
At some stage, it always kind of either pulls back or flattens out. So best case scenario, it continues.
Correct.
Worst case scenario, we see neutral growth.
And my absolute worst case, which I don't foresee happening, is we get 3 or more interest rate rises for just this year alone, and then people are hurting, and then people need to sell. I don't foresee that happening because I think they are trying their level best to get inflation under control. But that is a big unknown, and I'm actually quite thankful that, based on the last stats, that the government decisions, I was about to say meddling, I shouldn't have, I was thinking it, the recent government decisions are potentially not going to make as big a impact on our market here in WA as maybe first anticipated.
Time will tell, mate, won't it? Only time will tell. Jamie, as always, been a pleasure catching up with you. Thank you again, and we'll see you next quarter.
Thank you very much, Neil.
Thank you.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.